What's up, everybody? This is Big Mike over at foos4trading.com. I'd like to have a discussion today going over why short selling stocks works in any market environment. At Foos4 Trading, we just released Foos 4 times 3, which is basically our educational DVD on how to short sell. And given that the stock market is basically at all-time highs, I get a lot of people asking, Mike, why do you short so much when the market is, where it is? There's a couple of things I want to talk about that today. A couple of reasons being, guys, as traders, there's two things that we really look for. Obviously, number one, being technical traders, we look at charts. We like to look at patterns that tend to repeat themselves over and over again in a repeated fashion. But besides the patterns, you need to dig a little bit deeper and look at certain fundamentals that are going to give you a better gauge on really where that company stands from a financial standpoint. At the end of the day, I don't care if a stock has gone from 1 to 1,000. If that company is in really bad financial situation, eventually gravity and just logic and rationale are going to take over. So obviously fundamentals you can look at, and then logic and rational reasons are always going to kick in. The reason short selling always works, though, guys, is for a number of reasons. Number one, we as humans, our brains are engineered to chase stocks. When we see a stock go from 1 to 2 to 4, our minds and our brains and our emotions think that, maybe this is just the beginning. And the truth of the matter is, most of the time, and I say most of the time because there are outliers, this is false. Usually when your emotions are at the most euphoric and when you really want to buy a stock after a major run, there's a higher statistical probability that the stock is most likely going to reverse. Usually when your fear is at its highest is usually the best time to short or buy. And that's just kind of counterintuitive thinking. So as humans, because we tend to chase so much, it's just a general population, most traders tend to chase in long stocks. As short sellers, we look to capitalize off of their irrationality and their emotions. So that's one primary reason. Number two, stocks tend to go down a lot faster than they go up. For example, we've all seen Bitcoin go from 1,000 to whatever it was, 19, 20,000 last week. And it's basically dropped 30 to 40% in the past two days. That's just a really perfect example of how fast asset classes can sell off versus them appreciating. So another reason also is that majority of people can't short sell and are not able to locate shares. You need to have a margin account to be able to short sell. You need to have a day trader friendly broker that is going to be able to get you shares to short. And also you need the capital to be able to do it. You definitely need deeper pockets in order to short sell, not only for margin purposes, but just to withstand possible drawdowns. It's obviously a much more aggressive strategy. But these are primary reasons why short selling is an advantage in any market. Most people can't, and most people choose to chase. And more importantly, like I said, guys, logic and rationality always take over in the end. So two stocks that I'd like to use as an example are CUR as well as VTGN. We'll talk about CUR first. Now, this is basically a biotech stock, guys, that has gone from 95 cents to as high as $3, within a single trading day. 200% move. So if we look at a longer term chart, this is your 15-minute chart. So the news behind this initial move was that the stock had positive phase 2 results. Obviously, being positive news, phase 1, phase 2, phase 3, 2 and 3 definitely tend to be more important. So you get this really textbook F1 pattern, on December 5th, right out of the open. Stock goes from holds a buck, which tends to be a huge, psychological support zone, and we rip over highs at 130, and basically just within the first 45 minutes, all the way to 240. Really just incredible move. And then the stock starts to pull back. Now, one of my rules when day trading, guys, is when float rotation or when the float starts to exchange hands over and over again starts to become, starts to take place, I'm much more hesitant to short sell these stocks, because what you have is, doesn't really matter what the news is, doesn't really matter fundamentally what position the company is in. If you have float rotation, it basically reverse engineers a short squeeze because the float contracts, shorts get squeezed out, and that's basically what happened with Cure on day one. You had major float rotation, you had higher lows, we hit 180, broke the VWAP towards the afternoon, 190, higher lows, and there's really nice resistance zone at about 240 where there was a huge seller. So once this squeezed towards end of day, just a perfect example of why float rotation makes all fundamental analysis and the financial situation of the company out the window, at least for that day. However, towards the latter part of the afternoon, you had news come out that apparently their phase 2 results were a little bit fluffed and were already released prior. Did the market care about this news? No. That's why the stock still went to $3. However, on day 2, after the day 1 major move, this news starts to sink in that the news was already out. It's old news, and possibly fluffed in terms of whether the drug was positive or not. This is your time to short sell, taking advantage of a huge appreciation in price. And more importantly, once you see the stock reverse and you have a resistance level such as a whole number like $3 in place, that's your resistance zone to work off of. So this thing basically, looking at the open, breakdown zone was at about 280. We peaked at about 270. And within the first hour or two, this thing was down 30% to almost $2. And then you can see for the next couple of days, basically just chopped around and continued to trend lower. So to really capitalize off of this major wash right out the open from about 270 to $2, almost a 30% return within a day, is a perfect example of our short selling strategy. Looking for a stock that makes a huge appreciation in price, ideally 50 to 100%. Once the news settles in and the backside of the move is confirmed, and by backside I mean you have resistance set in to work off of, that's your time to begin to short. And keep in mind as well, volume was dramatically less on day 2. We traded almost 50 million shares, 55 million shares on day 1, and then day 2, 9 million. So you don't have that buying pressure there to sustain the move back to the upside, and this is where volume is really key, guys. At the end of the day, all you really need to look at is price action and volume. And if volume is not even close to where it was on the initial breakout day, you're probably not going to get that day 2 follow through. Just another indicator to look at. So this is just a perfect example of the way people love to chase stocks even after stocks up 100%. And people don't really care what the news is when you have a stock that's rotating its float. It basically becomes a trading vehicle. So this is just one good example of a stock that we look for. Ideally, you want to see a stock that's made 50 to 100% move to the upside. And on the short side, you like to look for that 20 to 40% crack back to the downside if the move is really not justified. Cure being a perfect example, as well as VTGN. Again, another stock that's pretty beaten up. Threw a PR out there that they got some type of patent approval, and this thing basically went from 70 cents to about 270. And once again, just showing you guys the market doesn't really care about whether the company's in really bad financial position. VTGN is another one that is just really fundamentally a crap company. But you can see that this basically went from 1 to as high as 260 and basically rotated the float 3 times on day 1. And then you get this really incredible drop towards the end of the day. Company once again threw PR out on day 2 that was the same PR as day 1, just to pump the stock up. This is a perfect example of an intraday double top right at about 265. Now that you have this really clearly defined resistance point in at 265 to 270, that's your zone to short off of. So again, to get in between 240 and 250, risk 10 to 15 cents to possibly make 40 or 50, that's a phenomenal trade. And this is once again a stock that, same thing, tried to throw the same PR out that was 2 days old. You still had people buy into it, which created another short selling opportunity. You can see that on the second day, clear resistance at 230, clear resistance at 230 on day 3. So this is where support, resistance, volume, and price action come into play, guys. And much more importantly, looking at volume, You can see that huge selling pressure on day 3. This thing went from 230 to 180. So these are stocks that you can trade for multiple days back to the downside, guys. Obviously, longing a stock, you can make money on day 1, but to be able to capitalize multiple days in a row, short selling a stock back to reality and back where it deserves to be on really news that's irrelevant. This is where short selling, in my opinion, is just much more of a rational and predictable strategy than longing some of these stocks. So I hope this was a pretty good example. Check us out, trading live every morning, guys, foos4trading.com.